welcome to Pursue the Pull, the podcast that is geared towards helping people who are looking for a career change, but also for those who want to start their own business and pursue their dreams. Now, how do we differ from all of the other inspirational podcasts out there? Well, what we do is we interview people from a range of different industries. So if you want to set up your own restaurant or start your own marketing agency, whatever it might be, we have someone specific from that industry to tell you how to get started, the highs and lows, and most importantly, the truth. Now, we are one group, one community, and we have all of the answers. I am your host, Stacey Bevan, and today I have an amazing guest. His name is Rayhaan, and he is the founder and CEO of Sidekick Accounting. Now, this is going to be a slightly different interview from all of the other ones that I've done before. So Rayhaan is here to actually tell us everything that we need to know about tax when starting a business. And, you know, this is an area that I struggled with because I didn't learn anything to do with tax in school. So when I started a business, I had no idea how it all worked and what I was meant to do. So, you know, I know a lot of people are struggling with this as well, because we actually had a lot of requests from our audience to get someone in to give us this advice. So first of all, I just want to thank you so much for joining us, Rayhaan. We really appreciate the insight that you're going to give us all.
Thank you for having me, Stacey. Looking forward to it.
Yes, me too. Okay, so before we go into the questions that have been devised by our audience, I just want to give a bit of background into what it is that you do and the kind of services that you offer. So the company has been trading for almost 3 years, and you've worked with some very exciting businesses. Now, your mission as a business is to make an impactful difference to the financial future of thousands of entrepreneurs by removing the complexity of money. Now, business owners must understand their numbers to make the important decisions they need to live the life of their dreams. Now, your business Sidekick helps by turning numbers into actionable insight alongside game-changing levels of support. Now, you're all about redefining the word of accountancy and the word of accountants and pushing the boundaries of what an accountant is for small business owners. Now, gone are the days when an accountant is someone you speak to once a year just to be told how you need to pay your HMRC, or pay HMRC, I should say. Now, you believe that today accounting is about growth, and an accountant should not be a cost to any business. Currently, for me, it is. But they should be a profit driver with a measurable ROI, whether that's through strategic growth support or effective tax planning. Now, your services range from supporting startups with the right company setup, systems and tax plannings, through to supporting fast growth businesses with a fully outsourced CFO function. Now, going forward in 2024, you have an awful lot of plans, and it's going to be a huge year for you. But you are currently recruiting an operations manager to help keep the client engine running so you can spend more time focusing on strategy and growth. That means more valuable content with a larger reach and the ability to help clients in different ways through the new product launches. Now, on average, you actually save 23%. You save clients 23% on their tax bill. And that's not because you do anything abnormal, but simply because 99% of accountants do not have a tried and tested process to assess business and personal goals and match that with a complete understanding of the tax rules and opportunities that are out there. Now, there was a Forbes article published recently that said 95% of businesses are overpaying taxes in the UK, and you've seen this firsthand and you're not surprised. So, with that being said, which is all great, and I really believe in your mission, I think it's amazing, and we need businesses like yours. So let's go into the first question, because I just want to know a little bit about your background and what you did and how you got started before you actually started this business.
Yeah, sure. So I went to university and studied accounting and finance, which is quite a typical path for people around me, and specifically Asian people, quite frankly. So I didn't know what else to do, so I went down the accounting route because it felt like a solid profession. But while I was there, I also constantly told myself I'm never going to be an accountant. Here I am today, a chartered accountant. So following university, I decided to try my hand at business. So I didn't apply for any jobs or anything else.
Okay.
I went on with a partner to set up a property management company. So we did that for about 6 months, and I guess taking a step back, my background has always been very entrepreneurial. So I've always had in my mind I want to set up a business, but I've also wanted security that education brings, plus potentially employment as well. So I decided that was the time, or I thought that was the time for me to go into business. So 6 months in, and I realized property management probably isn't the type of business I want to be into. I felt like I could have more of an impact if I'd develop myself further before going into to do my own thing. So kind of took a U-turn on business at that point, with it still being something I wanted to do eventually. And I started applying for jobs. So I ended up landing an audit job at EY, which is one of the big four accounting firms. And just by chance, it was audit. I didn't really want to do audit, and I didn't want to be an accountant. But in order to get onto that grad scheme, you had to start studying as for your chartered accounting exams. So there I was, told myself I'm going to transfer from audit into a different service line as soon as I get into the business. I think a lot of people have that in mind because it's almost impossible to do once you're there. So stuck at it for 3 years. I did find, as I was there and developing and meeting people, there was more to it than just the job and the title, in terms of it wasn't purely audit. It was learning how to interact with people, learning how big organizations run. And it's through that really that I understood the power of accounting and numbers. Like if you can read a profit and loss and you can read a balance sheet, you're able to understand the financial health of a business and make really good decisions. So as time went on and I got over the fact I was an auditor, I started to see a lot more benefit outside of the day-to-day job. So that's, I guess, where I started to see the value in accounting as I was studying it. So I qualified as an accountant, and on literally the day I got my results, I moved out of audit and into management consulting. So I transferred because I wanted to apply that knowledge, but also learn some more strategic skills. So within EY, I moved into their consulting practice. And for 2 years, I was working with banks primarily. So HSBC, Monzo, and a few others on their strategy and operations. After a couple of years of that and traveling all across the country every single week, I kind of had enough of the consulting lifestyle. So I had an opportunity to join a building society close to home, and I started. They wanted me because I'd had experience working on operations and strategy within banks, and they wanted to bring themselves into, at that point, 2021. So they had a big digital transformation program. So in that role, I managed budgets of 10 million to help transform this building society to become more attractive, I guess, to a younger demographic. So I did that for a couple of years, and then COVID hit. We were working from home, and I was getting a bit bored in my role. And I thought now is the time when costs are limited. I've managed to build up some savings from not traveling and not doing anything. It's time to jump ship and try for myself. So initially I had in mind, I'll just become an accountant, and it will give me flexibility in terms of time and a bit more financial freedom to then go on to do something I actually really want to do. But what I found through that process is that the traditional way of accounting is not, it doesn't benefit business owners. It ticks a box. So there's a real opportunity there for me to add value through something that I was learning to love and enjoy. So the business pivoted from doing your tax returns and sort of compliance work that most people think of when they work with an accountant, to providing more strategic support, helping business owners get access to all of the stuff I'd learned from working with the biggest organizations in the world, and packaging that up in a way that really does support all business owners in a very unique way. So here we are, 3 years in, and we have a really good well-tested product and service that provides a ton of value to our clients. And I'm loving it as well. So
yeah,
all good news.
That's amazing. The first question that I'm going to ask that is came through for our audience. So how does tax work?
Essentially, the government wants a piece of everything that you do. So tax is money that they take from you for working, for buying a house, for dying even, and they use that to support government services and also those that are in need, ultimately. So how do they work is a big question. We can cut it up in a few ways. So if you're a business owner, that's the first piece of tax you're going to have to pay. You're then taxed personally, so your business is separate to you. So if you're employed, obviously you'll pay your tax through salary. But if you're a business owner, you're going to pay corporation tax, and then you're also going to pay personal taxes for taking that money out of your business.
Okay.
So that's the tax on income. You also have taxes like VAT, which is a sales tax. So if you want to buy something, you are paying the government tax for the privilege of spending your money. You also have stamp duty, land tax, for example. So you buy a property, again, you're paying the government a tax for the privilege of buying your piece of land or your house. So there's loads of different taxes, tons of them, and they're all there to fill the government's pot, and the government has their own budget, and they have to have income and expenditure matched off, or at least in the long term, income and expenditure matched off. So they adjust different tax rates to bring in enough money to support all of the things they're doing, which could be the NHS, schooling, foreign aid, anything else that keeps the country running.
Okay. And we've got another question here. What is the difference between tax deductions and tax credit?
So a tax deduction is a reduction of the amount you would pay tax on.
Okay.
So if you earned £100 and you spent £20 on something that is tax deductible, you would pay tax on the £80. So your tax saving there is your tax deduction times by your tax rate. So you're getting a percentage of your deduction. A tax credit is a pound for pound amount back to you. So again, in that situation, if you were due to pay £100 in tax and you had a £20 tax credit, you would only pay £80 in tax. So one is reducing what you pay a percentage on, and the other is an absolute reduction in what you're paying.
So, and this is just to add on to that question, like who is eligible for tax credit?
Businesses and individuals. There's a few tax credits. I guess the most common ones from a business point of view right now are research and development tax credit.
Okay.
So if you invest or spend money on pushing boundaries in your field from a technical point of view, you can class that as research and development expenditure, and the government will give you a credit back. And that can be literally cash back in your bank rather than just offsetting against future taxes. Individually, people get child tax credits, for example, or they have a tax refund is even an example of a tax credit. So if you've overpaid taxes in your job, at the end of the year, HMRC will reconcile everything, and then you may get a tax credit back, which is a pound for pound amount back in your bank account.
Okay, good. And we've got another differentiation question. So what is the difference between tax avoidance and tax evasion?
So evasion is the one that will land you in prison. So avoidance is, let's talk about avoidance first. Avoidance is minimizing your tax bill through legal means. So putting in place strategies and planning that are designed to reduce your tax bill, but within the rules that HMRC prescribe. Tax evasion, on the other hand, is like taking a cash payment for something you've done and putting it under your mattress and not declaring it to HMRC. So one is purposely not paying your taxes, and the other is being smart about how you structure things and what you spend.
Okay. And tax returns. This is the one that I got confused with, to be honest with you. And I was a startup and I did have to get an accountant because I just didn't understand when or how I had to do this. So do we need to do this as a startup business, or should we hire an accountant?
So as a startup, you've got a couple of routes you can go down. You can work and trade as a sole trader. So you as an individual, in which case you would submit a personal tax return each year.
Yeah.
Or you can work through a limited company, and that limited company would be due to file a tax return once a year.
Mm-hmm.
So the sole trader route, yes, you need to file a tax return. Can you do it yourself? Yes, a lot of people do. It's relatively simple if you're already keeping track of your income and expenditure. It's a form that you fill in and you put, this is how much profit I made in the last year, and then this is how much tax I'm due, and you self-declare how much you owe. For a company, it's slightly more complicated because you need certain software in place and you need to produce company accounts. And at that point, you really do need the support of an accountant, because it's rarely worth someone's time learning and signing up to software and being able to file that in an effective way. Also, if you have a basic sole trader business, you're not going to miss out on much, if any, tax deduction doing it yourself if you're relatively clued up and you can use Google. When it comes to a company tax return, a good accountant should pay for themselves in the advice that they give and the additional deductions you might be able to claim, and maybe changing the way you structure things before you submit those returns. It's a judgmental situation. If you're comfortable from a personal tax point of view, it's very easy to do. If you're a bigger business and company, you're going to need the support from someone external.
Yeah, I was actually confused as to what to go with. Do I register as self-employed or do I register as a sole trader? Because my plan was to grow and, make the business bigger, but then I was on my own at the start. So what determines which one you should kind of go for? What makes it so you should be applying as a limited company as opposed to a sole trader?
At its most basic level, you could look at it as an income threshold. So
okay,
if you weren't earning money from elsewhere and it was purely business income in any given year, most people feel like it's worth it at about 40 or 50,000 pounds turnover. And that's because firstly, there's tax savings, but there's also benefit from a deductions point of view in terms of what you can put through a limited company versus what you can put through your sole trader business. So as a really, really general rule of thumb, 40, 50,000, you want to start thinking about it. The more detailed answer is if you have other income, so you're employed and you have a side hustle, a limited company might be a better way to go because you have more flexibility around how you take profit out. So you can minimize your tax liability and you've got a lot more flexibility. Another reason might be if you have big growth ambitions or you're working with big companies and perception's important. A limited company usually looks a bit more reputable than a sole trader. So there's loads of different considerations. The planning side of it, in terms of is it worth it for you as an individual, would come down to really your other sources of income in the first place.
So if I went straight into being a limited company because I wanted that credibility, because I'm working with big companies, it's not going to impact me from a monetary perspective, is it, if I go straight into being a limited company and I'm earning less than 40k in that year? It's not going to...
You might end up paying a little bit more in terms of what you will pay a little bit more in terms of accounting fees, because there's a lot more work involved in creating a set of company accounts and tax return. From a tax point of view, it would generally be negligible. You're probably better off as a sole trader from a purely financial perspective until you hit that threshold. However, the amounts we're talking about are in the low hundreds rather than the thousands. So, often you can weigh up the perception versus a couple £100 and it's probably worth going down the limited route.
Okay. And we've got another question here. And, this was actually quite a common question, believe it or not. But how can I avoid paying tax or paying less?
So I don't think you can ever get away from paying tax in the UK completely. Paying less tax is absolutely something you can do. And the first step is always education. So knowing what is a tax deductible expense, what's allowable, and making sure that day to day you're kind of following those rules and putting everything you can through your business. So you
Sorry,
want to
what are
maximize.
some examples? Because you've mentioned this a couple of times. What are some examples of tax deductibles?
So it could be anything from buying a new phone. That could be tax deductible for your business. It could be pension contributions if you do that via a company. If you have borrowing or a mortgage, the interest is sometimes also deductible. Mortgages are a bit nuanced, but a straightforward loan, for example, if you had a business loan and you were paying interest, that would be deductible from your profits. So anything that you buy through your business that is a legitimate business expense is a tax deductible. And then when you want to maximize those deductions, you want to start looking at what do you spend personally that could actually be a business expense in order to maximize the deductions that are going through your business.
So that could be things like petrol costs.
Yeah, maybe company cars are a great example. So right now, electric company cars are super tax efficient. So instead of taking money out of your business and then paying a lease cost or a finance cost on a car, you can just do that out of untaxed money within the company and pay a very small amount of personal tax for the privilege of doing that. So that's a great way of putting some lifestyle spend that would otherwise come out of tax income through your business to reduce your taxable income and ultimately pay less tax.
Right. Okay. So the avoiding paying tax is not there. I mean, I know that there's some countries that you can go to where you don't have to pay tax.
Yeah. If we start to look at tax, so I guess just an overview of tax. You've got your tactical sort of deductions, which we've just spoken about, which are kind of the base level if you think of like a pyramid.
Yeah.
You've then got tax advice, which would sit above that. So looking more strategically at how you structure your affairs, what your goals are, and how do we plan for that. So an example of that is if you wanted to buy a property in a couple of years for investment purposes, we would provide advice on how you structure things now so that when it comes to purchasing that property, you're optimized for tax. And then the top level is tax consultancy, where you look much more holistically at everything that's going on in someone's life and in their business, and then you develop a bespoke strategy around that. So one of those strategies could be, do you, Stacey, want to live in Dubai? If you do, you could move there and pay you pay a little bit of corporation tax and no income tax. But we would then need to factor in a bunch of other things around your other affairs in order to say that's a viable option for you. So you kind of step up the ladder. If you're looking at what you can do with a UK limited company, you can't avoid tax. If you're willing to move to another country and stay there for a number of years, you can pay no tax, ultimately.
But would I still have to pay, say I had a limited company in the UK and I moved to Dubai, would I still have to pay tax in the UK?
You would pay corporation tax in the UK. If you met certain criteria when you moved in terms of your residency and domicile status, you would pay no income tax when you take money out of that UK company.
Okay. And we've got another question here. How much do I pay myself as a company director?
So again, the basic tax strategy that every company director should follow is you take out salary and dividends up to your basic rate allowance, which is 50,250, I think, off the top of my head. So up to that amount, you're able to take profit out of your business and pay the lowest rate of income tax on that. Now, when we talk about splitting it between salary and dividend, what we're saying is you've got that bucket of 50 odd thousand. and you want to extract in a combination that is tax efficient. So the first thing that you have, and everyone has, is a tax-free allowance, and that is £12,570 this year. So you want to pay yourself £12,570 as a salary, and you'll pay zero tax on that.
Okay.
And then the next step is to start taking dividends up to that 50 limit. So you take dividends out because they're the second lowest taxed income you can get to. So the first £1,000 you take out, again, no tax. And then everything up to that 50,000 will be taxed at 8.75%. So that means you're able to take out up to 50K and pay just over £3,000 of tax, which isn't bad.
Yeah.
Once you want to start taking more than 50K out, that's where you come across issues, and you need more, bespoke tax planning, because you start to get taxed at 35% plus, however you cut it.
Yeah.
So at the basic level, everyone, or 99% of company directors, will take out up to 50,000 in that way.
Yeah, to avoid paying the large sums of tax.
Yeah, so you kind of keep yourself in that lower rate band. And then if you need to extract more profit, then we start to look at stuff like we mentioned, cars and other lifestyle spend that could go through the business, which means you don't need to take more out, but you can utilize that company to spend on those things.
Okay, and we've got another question. Are there tax implications if I get a loan for my business, which a lot of people do?
The implication is that you, it's a tax deduction. I guess we just touched on that briefly, but essentially the interest element of that loan can come off your profits. So it's reducing the amount of tax that you pay. In terms of a company taking out a loan, there isn't really any other tax considerations. There's one area which trips up a lot of people, which is loans from the business to the director, because that can trigger taxes like benefit in kind on the director personally. And there's also some other company taxes that are super high and nobody wants to hit. So if you're borrowing money from your company, you have to consider a few different taxes. But if your company is borrowing money from elsewhere, there isn't much to consider. Just know that you can take the interest as a tax deductible.
Okay, amazing. I didn't know that about the interest. See, just not taught these things in school, and I've had to learn as I go, but there's still things that I don't know. Okay, so what are the mistakes that people can make when it comes to starting a business? Well, obviously, with me, I don't know what I can claim, so it's a big one.
Yeah, from a tax point of view, it's just having the right setup. So getting some guidance or understanding of whether it's beneficial to be a sole trader or a limited company. In terms of a startup, that kind of startup tax point of view, that's really all you need to consider at that point. I guess thinking outside of tax, what do people want to consider, or what mistakes do they make even? Most people tend to focus on the wrong thing. And I did the same thing when I started my business. So you want a fancy name, you want a brand, you want the website, you want to subscribe to all this software that you see everyone using. And the reality is all of that distracts you from what's actually important for your first 100 or even 200,000 pounds of revenue, which is sales and marketing. So people get really caught up in all the flashy stuff and the perception side of things. Whereas the reality is if you don't have any of that, you can set up a super cheap landing page and have a brand name that's kind of put up in 5 minutes. If you're getting your marketing right and your sales right, your business is going to grow far quicker than having a fancy website.
Yeah. That is something that a lot of people do. And, just going back to the tax returns, like I say, that's an area that I kind of struggled with. Would you say, for people to keep all of their receipts on everything that they spend, and just what would you advise from that point of view when it comes to doing the tax returns?
Yeah, bookkeeping is super important. from a compliance point of view, you need to retain those receipts for up to 6 years. So you should have them put aside. But again, we're completely digital. We use something called Dext with all of our clients, and anyone can sign up to Dext. It's a great app that lets you capture receipts on your phone so that they're all logged in place, so you don't have a folder full of 6 years worth of paperwork.
Yeah.
But yeah, you should keep it, especially everyone should keep it. It becomes even more important when you're VAT registered, because to claim back VAT, you need to have a VAT receipt with the VAT number and the VAT amount split out. And if you don't have that and you get investigated, you would need to pay that VAT back to HMRC. So retaining receipts is really, really important. And it's a good habit to get into whatever stage of business you're at.
Yeah. And then would you advise like keeping like some sort of spreadsheet so that, you know, when it comes to, because I know some people that have a separate bank account and they put a certain percentage of what they earn in there. So when it comes to the end of the year, they've got their tax money, if you like, ready. And I actually got a shock because I didn't know that I would have to pay a certain amount for the year ahead. So
yeah,
can you explain that? Because that was a shock to me. And I know a few people that's happened to, and they're like, why do I have to pay that now? So can you just explain that process? Because it's caught quite a few people off guard.
Yeah, so what you're talking about is called payment on account. So you file your tax return and you have payments due in January and due in July. What happens is HMRC wants you to pay in advance for the following year. So in January, you're going to pay your tax bill, but then you're also going to contribute 50% towards next year's tax bill. So most people don't anticipate that. So they get hit with half a year's worth of tax that they have to front. And it's really difficult. It can cause some serious cash flow issues for especially small and growing businesses. So I think, again, having an accountant, again, that would be a use case for an accountant, because they would be able to give you that foresight to say, this is how much we estimate your tax bill will be, and this is how much we estimate you're going to contribute towards next year. So you can plan for that far in advance. But yeah, it catches out so many people, and I don't think enough people know about it, especially when they're starting up.
No, and that estimation for the 50%, is that based on what you've earned the previous year? So it's just a forecast of that, and then the 50%.
It's based on that, yeah. It's based on the last year.
Okay, and you have to pay all of that 50% up front at the same time that you're paying for the tax for the previous year.
Yeah. And then, so you paid 50% in January, you paid 50% in July, and then the following January, when you filed your return and your payments due for the previous year, you would take the 100% that you paid and assess that against the amount that you've actually submitted. And if there's a difference, you'll either get that back or get it as a credit towards next year's tax bill. Or if there's more to pay, you would need to pay that in January as well.
Interesting. Okay, and look, we've got a last question. I know there's probably going to be more after this interview, but because I've got quite a few more. But what advice would you give to people who are thinking about starting their own company? And this can come from the point of view of, you've done it yourself. So what advice would you give to people who want to do that but have a lot of fear? There's people that have a lot of fear when it comes to starting their own business, but also there's a lot of fear, and this was kind of a last question that came up, but I'm just going to ask you now. But I had someone who had their own business and they were doing their tax and everything, but they were so scared of what was involved from an accounting point of view to take it to a next level. They decided to be complacent and be like, look, I don't want to grow my business. I'm just comfortable doing this. So what advice would you give to people who are thinking about starting their own company? And then what advice would you give to people who want to grow that business but have like that fear that I mentioned in terms of the accounting kind of side?
So advice to people wanting to start and scale a company would be know your numbers. And I'm not just saying that as an accountant, but having that story of your business performance today and being able to predict your performance in the future does so much to alleviate that fear, because you're basing decisions on data and on projections and something you can see. So the mistake that a lot of people make is they don't have that foresight or visibility, and they're making decisions today without any understanding of their future impact. And that's where fear comes from, because if you get burnt and you've spent your tax money, for example, and then you realize 6 months later that you've kind of shot yourself in the foot, you're going to be scared to take those big decisions again in the future, which you need to take in order to grow your business. So always understand your numbers. It doesn't matter how big or small your business is, just knowing basics like how much profit have I made, how much tax do I think I'm going to need to pay, would go so far in alleviating fear. And it's something that everyone should be doing.
From you personally, like I said, we've got a lot of people who want to start their own business, but they've got a lot of fear, or they've got, families that they need to support. So they're scared to take that leap because there's money that they might need or money that they should save. And, from your point of view, what advice would you give to people that want to start their own business, but there's just this fear or self-doubt?
Yeah, I mean, I think I would always advise, obviously, to make sure that you can support whoever you need to support and continue to live your life to an extent. So not sacrificing everything to go into something, because starting a business is always risky. You don't know how it's going to go, but if you get it right, the upside is massive. So just making sure that you have savings, for example, and you can survive for 6 months or 12 months or whatever you're comfortable with, making sure that you have children or family that needs supporting, you can continue to do that, is always going to be the most important thing. Once you get to that point where you have maybe some savings built up and you're comfortable that you can take this risk right now, that's probably the point to jump in. And that's the same with me. Like I mentioned, COVID helped because I was able to save some money up. But also I had, my life had changed in the sense that I'd got married and I was living in my parents' house. So I had a lot of stability around me, and I also had a second income that I could rely on, which for me took all the fear away, because I thought, you know what, I'm going to try it. If it doesn't work, I know we've got money coming in. My wife was able to support us. We don't have any massive outgoings, and it was the perfect time for me at that point. Had that not been a situation, I would have had a lot of fear and doubt and maybe wouldn't have taken that step. So I think people thinking about setting up a business, the timing has to be right in everything. So not just personally, but also the opportunity and the business that you're going into. Like, is it a good climate for that? Is this the right time? Are people buying your product or your service? Or maybe it's better to wait a year when you have that 6 month runway and the economy is doing a little bit better. Timing is everything, I think.
Yeah. And do you think that you had self-doubt even though you had that situation? I mean, people have self-doubt for other reasons as well. Like they're just, is this going to work? Shall I just go and get a normal job? It's more secure. Did you have any of that?
Yeah. So I quit my job in May 2021. Okay. I didn't actually land my first client till I think September. So I had a good few months of, and I guess one thing I've not mentioned is I was also paying a huge amount of money for like coaching and training and consultancy to help me set this up in the way I wanted to set it up. So for that period between May and September, my savings balance was depleting.
That's
I was
scary,
thinking, nobody wants to buy what I'm selling. And, is this going to work, or have I just thrown away tens of thousands of pounds? So that fear was definitely there, and it was a very stressful time. But I think if you've got that drive and you've kind of got in your head a timeline that you're and an amount you're willing to lose almost, and you kind of thought through that beforehand, then that does a lot to give you comfort that you're on a path that's controlled almost. You're not like on an uncontrollable and endless path, kind of know if it doesn't work out by this point, and maybe I'll reassess it. And in my head, that money and that time has just been put aside anyway, so it doesn't matter. So there was definitely a lot of fear and doubt for a long period of time.
Wow, that's quite a period from May to September, but it happens, right? It doesn't happen.
But that's also
overnight.
Just, coming back to what I said, like, the mistake I made was focusing on the stuff that wasn't driving growth in the business. It was the stuff that maybe I should be looking at now. So like we've rebranded, for example, now. But back then I spent weeks thinking of a name, which is gone now because I've done a full rebrand. So it was a waste of time, it was a waste of energy, it was a waste of money, and it did nothing to grow the business. Whereas when I really started to thinking, what do I need? I need money. How do I get it? Well, the only way is effective marketing. What do I have? Time. So every hour of the day should be spent marketing in order to get some money, instead of getting distracted with all of the flashy and nice things that come with building a business.
That's really good advice, actually, because a lot of people do that and they try to perfect everything, don't they? Even their presentations, everything. So they want everything perfect. And, you know, a lot of entrepreneurs have said the same thing. No, don't focus on that because things will change, you know, as you start getting clients and you start growing. So that's really good advice.
You don't really know what you're providing or what drives value or what your target audience value most until you start doing the work, and that's going to change everything else in terms of how you position yourself and the stuff you talk about. So it's not important to perfect that until you actually know, based on data, this is what people want and this is what the market needs and this is how I should be presenting myself. But it's really easy to get caught up and just like have a flashy website name, brand, business cards, all of that. Like
so easy. I've done it myself. No, it definitely is. But look, you have been fantastic. Like I love these conversations, and I know this is going to help a lot of people because it's such an area. And it's a shame that, you know, in school we're not taught about this. You know, I wish that would actually change because, you know, there's so many of the younger demographic as well that have approached me and said, look, can you do these kind of interviews? Because, you know, they really want to know and they want to start their own business, but it's a fear for an awful lot of people. So I really appreciate you coming on and just breaking it down, you know, to a level that, you know, we can understand. So thank you so much. And it was great to meet you.
You too. You too. Thank you. I hope this has been useful to your audience.
I'm sure it has. Even me. Thank you so much. Have a great day. Bye.